Good morning, everyone. My name is Michelle, and I'll be your webinar moderator today. Today's webinar is sponsored by NatRoad's Platinum partner, Bridgestone. Tires are your vehicle's only point of contact with the road. That area of contact is the size of your hand, meaning the lives of you and your loved ones are riding at great speed on just 4 handprints of tread. That's why it's important to choose a tire brand you can trust. Bridgestone, you're in safe hands. Today's webinar is being presented by Anthony Harmer. Anthony is a director in Deloitte's indirect tax team based in Brisbane. Anthony leads Deloitte's national fuel tax credit practice and works predominantly for the road transport sector. Like always, we'd love to hear from you during today's presentation. So if you have a question, please feel free to type in your questions in the Q&A section at the bottom of your screen. You may send in your questions at any time during the presentation. So welcome, Anthony. I'll now hand over to you.
Thank you, Michelle. Hi, everyone. So today we're going to be talking about practical steps for claiming your fuel tax credits. To start with, I'm just going to go through a little bit of the background of fuel tax credits just to set the scene a little bit. So as we all probably know, there's 43.3 cents of excise embedded in every litre of fuel purchased at the pump. And similar to the GST input tax credits, the fuel tax credit regime exists to provide businesses with a credit equal to the current rate of excise for fuel consumed while carrying on its enterprise. That entitlement is subject to 2 exceptions. The first being that you're not entitled to claim fuel tax credits for fuel used in light vehicles traveling on a public road. And the second is that you're entitled to fuel tax credits at a reduced rate for fuel used in a heavy vehicle for traveling on a public road. And that's probably the one that everyone's most interested in today. So as you can see there, the on-road rate is currently just under 17 cents, whereas the full rate is 43.3 cents. And the difference there is what we call the road user charge, which is basically a charge levied on heavy vehicles to recover the wear and tear created by those vehicles on our public road system. So back in 2012, Deloitte successfully argued during the Linfox case that fuel used in Linfox's refrigerated trailers was not fuel used for traveling on a public road. And because the fuel was deemed not to be fuel used in a vehicle for traveling on a public road, the road user charge did not apply. And in that case, Linfox, as the litigant, was entitled to an approximate 25 cents per litre refund for fuel used in its refrigerated trailers. And most of the industry are probably claiming, the full rate for refrigerated trailers and other equipment already. So following the Linfox case, we expanded, that auxiliary fuel use concept, and we assisted taxpayers in calculating what uses of fuel were not used, were not for traveling on a public road. So as you can see there, things like refrigerated trailers, your waste management vehicles, diesel-powered air conditioning, cement agitators, and similar. So because of the difficulties and expense associated with calculating auxiliary fuel use, back in 2016, the ATO published what they call safe harbor rates, which allowed taxpayers to rely on specific percentages to allocate fuel to uses other than for traveling. This was to be used in the cases where the client didn't undertake specific testing. We were always of the view that these percentages are conservative, as they would be because they were published by the ATO. And so, advisors, including Deloitte, adapted to these safe harbors being published by undertaking that taxpayer-specific testing. So, for example, for concrete transit vehicles or cement agitators, the ATO says you're allowed 30%, whereas testing that we've completed for some of our large concrete clients show that it's in all likelihood above 50% of total fuel is used both for spinning the drum through the PTO and also off-road. So following on from the safe harbors being published back in around 2017, many taxpayers had conducted that testing or were relying on those safe harbors. but the process of calculating fuel used off a public road was still very manual. So it required taxpayers and advisors to review driver run sheets and delivery dockets, maybe time slot information down at the port, and come up with these manual off-road claims that were very, very time-consuming and cumbersome. So during this year, during 2017, the industry, Deloitte, we were one of them. We developed software that assisted in, analyzing that GPS data and coming up with an off-road usage for vehicles that didn't have auxiliary equipment. These GPS-derived calculations, though, brought with them their own challenges, including difficulties when the ATO wanted to audit it because it was first of its kind software. And so over the past few years, there's been a move to what we call the deductive method. The GPS-derived calculations assist with this. So what this does is you calculate your on-road kilometers, multiply them by your average on-road burn rate. And what follows then is, because you've tracked your on-road fuel, any other fuel that was pumped into the tank of that vehicle for that month is eligible at the full rate, because it was either used in a PTO or it was used off-road. So that's what the deductive method is. Which brings us to 2021, and I understand there's been a lot of questions in relation to this new simplified fuel tax credit method that the ATO has released. So on the 9th of February this year, the ATO published that practical compliance guideline, which they refer to as PCG 2021/2, which is the fuel tax credit basic method for heavy vehicles. And what this offers is, this offers business a simplified apportionment method that can be used when calculating fuel tax credit entitlements for diesel used in heavy vehicles that travel on a public road. Use of this simplified apportionment method is restricted to businesses that claim less than 10,000 Australian dollars of fuel tax credits over a 12-month period. And that's tested both retrospectively and prospectively. So it's basically a rolling 12-month period. So there's probably not a great deal of NatRoad members that claim less than $10,000 a year in fuel tax credits, but if you are, you're well and truly able to rely on that. So what the PCG sets out is the basic method, what the ATO call the basic method for heavy vehicles, or BMHV. And what this allows you to do is work out the number of litres of diesel used by a vehicle for on-road use and off-road use using simple formulae. So for the purposes of applying these formulae, the ATO provides basically two safe harbour options to work out either the number of kilometres you've travelled on a public road, or your vehicles have travelled on a public road, or the diesel consumption rate in a heavy vehicle. So if we go back to that deductive method, your two variables are how many kilometers did you do on a road and what was your burn rate whilst you were traveling on a road. What this does is allows safe harbors to calculate either the number of kilometers or the diesel consumption rate. So under the BMHV, businesses can calculate the number of kilometers traveled on public roads using the following accepted percentage formula. And that's total kilometers traveled by the vehicle times 98.4%. So in this case, I suppose you've got two options. The first is that you can track your actual kilometers on road, and you can do that using GPS or delivery run sheets or whatever information you have to calculate that. Or in the absence of that information, you can say that for every 100 kilometers, 98.4 were traveled by that vehicle on a public road. So businesses using the BMHV are not required to use this accepted percentage. And you, as I said before, you're allowed to use whatever records you have available to support the calculation. The next one then, the next safe harbor is this diesel consumption rate. So under the BMHV, businesses can work out the vehicle's diesel consumption rate in a litres per kilometre format, using the relevant accepted diesel consumption rates as set out in Schedule 1 of that PCG. And that's what this table is here. So it sets out 11 accepted rates, as you can see there. with the applicable rate determined by a heavy vehicle's gross vehicle mass, or GVM, and its vehicle type. So what the ATO are saying is, if you're running a B double, they will accept that you use approximately 0.68 litres per kilometre whilst travelling on a road. So again, what you can do is you can download engine management reports that tell you what your average on-road fuel consumption is. You can use data that the ECU collects or that your GPS software collects, or you can rely on this. And again, you can use any combination of these. So you could calculate your kilometers on road yourself, and then you could rely on this fuel consumption figure. The other way around, you could be calculating your fuel consumption figure based on engine management downloads and then using the safe harbor for the kilometers driven on road. So it's an and or test. You're allowed to use whichever combination of those you would like. So going forward, we think that businesses with FTC claims below the AUD $10,000 cutoff should definitely consider making use of this simplified approach. However, a decision should only be made after considering the extent of greater efficiency that practical compliance guideline may offer, in terms of allowing you to not have to collect your own data or use GPS software or engage with an advisor. So it's, I suppose, a commercial decision as to whether the benefits of not having to do all of those things outweigh the work that would be required to sort of test it yourself. It's also noteworthy that the decision to rely on PCG 2021/2 is one that can be made on a vehicle by vehicle basis, and only in respect of an individual tax period being a month or a quarter. So the opportunity to selectively apply PCG 2021/2 is an additional matter for businesses to consider, particularly those operating a mixed fleet of vehicles or engaged in a variety of activities. So again, as long as your total fuel tax credit claim for the year is below $10,000, you could go on a vehicle by vehicle basis. If you've got vehicles with ICE packs or electric powered diesel air conditioning, you could decide to rely on the 5% safe harbor for specific vehicles. And then vehicles that are not entitled to a safe harbor, you could use this simplified method. So you can mix and match on a per vehicle, per month or quarter basis. And that's probably the end of the presentation in terms of the new simplified approach. What we are seeing is what we've seen over the years since 2006, when the fuel tax credit scheme came about. The ATO adapt to changes in the way claims are calculated by providing these safe harbor amounts. At the moment, it is just for those claimants that claim under $10,000, but there is a chance, as there always is, that the ATO will simplify things for larger taxpayers by offering similar safe harbor amounts in terms of your on-road kilometers and your fuel consumption figures. Again, we'd have to wait to see what those numbers are when they come out. Usually the ATO err on the side of conservative, as you would expect. So in a lot of cases, it may be worth weighing up, calculating those two inputs yourself, whether that's your on-road kilometers or your fuel consumption rate. And again, there's always tax advisors like Deloitte who can assist with those calculations and making decisions as to which road you should go down. So that's probably it from me. I don't know whether anyone has any questions.
Thank you, Anthony. We do have a couple of questions. The first one is, I don't understand how the road user charge works and why it needs to be part of the fuel tax system. Could you please explain?
Absolutely, yeah. So as mentioned earlier, the road user charge exists to basically pay for road maintenance in the national road network. So if you're in a light vehicle, you pay the full road user charge. If you're in a heavy vehicle, you also do, which is it reduces your full fuel tax credit, and it's basically meant to go into a pool of funds that the government use to maintain roads. Now, we're one of the only countries left in the world that has this system. If you look to New Zealand, they actually purchase their diesel excise free, and then use, they purchase their kilometers then. So if you plan on doing 100,000 kilometers in your vehicle that year, you, as part of the rego process, you purchase 100,000 kilometers, and those funds are used to maintain the road. Now, from what we understand, the federal government are looking at implementing a similar model, and under that model, there'll be no more road user charge. You'll purchase your kilometers, and it's likely that to the extent that you do any kilometers off-road, you'll be able to get a refund for the money paid for those kilometers used off-road. So look, it is a bit of an outdated system. The federal government seem to be aware of that. And as we move towards, high efficiency vehicles and electric vehicles, there's going to have to be some other sort of mechanism used to calculate those those on-road kilometers anyway.
Thanks, Anthony. We have a second question. What do I do if I made a mistake in calculating my rebate?
Sure. So you can actually, the way the fuel tax credit system works is you report your net fuel amount for the 4-year period prior to lodging that BAS. So it is possible in the next month or the next quarter, you can go back, recalculate the amount that the amount should have been, and you can actually just take that off, your fuel tax credit amount for this month. So at label 7D, you calculate your fuel tax credit amount. At 7C, there is an over or under claim option, and that allows you to basically fix up what you did the prior month. So as long as it's not a huge one and you're in a sort of big negative position, there should be no issues with fixing it in the next BAS. If you think that the problem's larger than that and you've been calculating it wrong for 4 years, it'd probably help to speak to a specialist fuel tax credit advisor if you have one. Obviously, Deloitte, we do a lot of work in this space. We'd be happy to have a free discussion and have a bit of a chat with you and see what we think that the best port of call would be, or the best actions would be. And we can look at fixing it up. But generally speaking, those small errors, you can just fix them up in the following BAS.
Great. Well, thank you, Anthony. And thank you, everyone, for attending today's webinar. If you have any other questions, please send an email to info@natroad.com.au and we can pass it on to Anthony. Today's webinar will be uploaded to the NatRoad website and our YouTube channel. Have a great day. Thank you.
Thanks, everyone.